Hello and welcome to Season 2, Episode 4 of the Talking Central Banks podcast with me, Karan Medici. This platform is exclusively dedicated to everything central banking, monetary economics, and policy technicals for observers across the world. Today, we will be talking about the future of the Federal Reserve as President Trump plans to restructure the central bank system. The discussion will therefore circle around the implications of these decisions on US central banking going ahead and how policy is made. This topic becomes relevant for our global audience given the implications these decisions have on the global capital markets, especially in the context of Kevin Warsh being selected as a replacement to Governor Powell. Our guest tonight is Jeffrey M. Lacker, who was the president and CEO of the Federal Reserve Bank of Richmond between August 2004 and April 2017. Prior to being named the president of the Richmond Fed, Jeff served as Senior Vice President and Director of Research at the bank. Jeff was an assistant professor of economics at the Krannert School of Management at Purdue University from 1984 to 89, before joining the Richmond Fed in 89 as an economist. He has published research in monetary economics, banking and financial intermediation, financial contracts, and payment economics. While at the Richmond Fed, he taught at the College of William and Mary from 1992 to 93 and was a visiting scholar at the Swiss National Bank in 97. Since 23, he has been a senior affiliated scholar at the Mercatus Center at George Mason University, and since 22, he has been a fellow at the Global Interdependence Center College of Central Bankers. Following his graduation in economics, Jeff joined Wharton Econometrics in Philadelphia, Pennsylvania, and went on to earn a PhD in economics from the University of Wisconsin in 84. Welcome to the show, Jeff.
My pleasure. Thank you for having me on, Karen.
You're very welcome. It's an honor. So, Jeff, if I may start with the elephant in the room, independently set policy rates are more predictable for businesses, investors, and consumers. Based on the past experiences pertaining to the US or any other economy, there is enough research suggesting negative consequences of political interference on these economies. In this context, Jeff, what is the state of Federal Reserve independence? And in your opinion, has it been damaged?
That's a great question right now. I think the assessment you'd get from looking at financial markets and the expectations they reveal about the conduct of policy going forward, I don't think that confidence in the Fed's independence, the independence with which it can exercise control over short-term policy rates, has been shaken terribly. I think that markets seem confident that the new chair will conduct policy with integrity and focused on the fundamentals. I think you can see this in comments that were made out of the White House around the Davos World Economic Forum in last month, where the president said, essentially, after you appoint them, they can do whatever they want. And I think markets recognize that as well, that the president won't have any leverage about them. And I think that's consistent with the historical record as well. The record reveals that it's really from within that independence gets compromised. So we have an example of a dramatic example from the early 1970s involving Arthur Burns and Richard Nixon, in which Burns actively cooperated with the administration. His philosophy about the Fed was that the Fed was part of government, and he actively wanted to maintain a very prominent role as an economic advisor to Richard Nixon. So he willingly went along with what Nixon wanted to do and making monetary policy more stimulative in late 1971 and early 1972. You'll recall that in the middle of 1971, there were a program of wage and price controls were enacted, and Burns genuinely believed, and this is what the president's other advisors were saying as well, that those price controls would keep inflation under control and would allow greater monetary stimulus in order to reduce the unemployment rate. Of course, the price controls came off in early 73 after Richard Nixon was reelected in a landslide in late 72. And the result was that that stimulus in the pipeline flowed through and inflation blew out from 3% to up to 12% by the end of the year.
Right.
So that was a willing compromise of independence from within. In contrast, in 1951, uh, President Truman appointed um, William McChesney Martin to the Fed as chair. He thought Martin would be his man. Martin had worked at the U.S. Treasury. He was a senior official in the Treasury Department then.
Mm.
And but when he was installed, Martin very much was his own man and set an independent course. He worked hard to make the Treasury market free, to allow government securities to trade at a market determined price. So he pulled the Fed away from intervening, which during World War II and through up to 51 had been manipulated. The Fed had played a very active role in keeping yields down. So he pulled the Fed away from pegging government long-term government securities prices and rates, and that was viewed as a real betrayal by Truman. And the story's told that later on the two of them ran into each other on the streets of New York, and Truman just looked at him and said, "Traitor," and walked away. So we have examples of both, and I think that's strong evidence that it's really up to the next chair. And in terms of independence, you can look at a speech that Kevin Warsh gave in 2010 to the Shadow Open Market Committee, in which, in fact, the title of the speech was An Ode to Fed Independence. So he
Right.
very much was a strong supporter, articulated very strongly the principles of Fed independence that we know and love. And that was while he was at the Board of Governors
Right.
back then. So I think he recognizes the value of independence. I think he understands the extent to which comes out of financial markets and recognizes the value of the confidence financial market participants have in the independence of the Fed. I think is going to be important for
Right.
him.
Jeff, you often talk about the uniqueness of the federated public-private structure of the Federal
hmm
Reserve. And there have been proposals to alter that structure now. How did
hmm
that come about and why, in your opinion? Also, how
Yeah,
does that
so
work in practice?
sure. So in the Federal Reserve was founded in 1913. The Federal Reserve Act passed December of that year. At the beginning, there were a lot of banking reform proposals at the very beginning for the decade or two before that. And at that time in American politics, there was this sharp tension between the interests of rural America, the South, the Midwest, the West, which was largely agriculture, but also manufacturing was blooming in the Midwest, for example, and the large urban financial centers like Chicago, but particularly New York, Philadelphia, and Boston to some extent as well. And the reform proposals all had to grapple with this tension. So, an initial proposal was to build a central bank modeled after some of the great European central banks, like the Bundesbank or the Reichsbank, I guess it was called then, and the Bank of England. But there was a strong um, resistance to the notion of a single central bank. And you have to realize that back then, around 1900, 1910, there were different interest rates across the country because it was costly to move money across the country, just like it was costly to move money between countries. And so the
Yep.
interest rate spreads between countries that you saw then, you observed within the United States between different regions. The
Mm.
Northeast were big savers, interest rates were high. The the West and the South, interest rates were lower. That ended after the Fed was founded, but there was pushback on the idea of a single central bank. And so they established this system of essentially 12 different regional central banks. And the key, let me take a step back here. This has to do with financial stability. Key problem was how crises were managed. And the problem in crises was that the supply of currency was sharply limited by the terms on which currency was issued. The National
Right.
Bank Act meant that it was really hard to issue new currency, get new currency out into the public's hands. And when there was a crisis, when there was a scramble for reserves and scramble for money, the large city clearinghouses would band together, especially in New York, would sort of band together and protect their own members, and
Mm.
they would not honor requests from country banks to withdraw money and to get currency out of their accounts at the larger banks. So
Right.
this was a big problem then, and what the Federal Reserve essentially created was a system of regional banks that were essentially clearinghouses. They were like clearinghouses for their regional economies. And so they were universal member clearinghouses where country banks could all join their local Federal Reserve Bank and be in a
Right.
little clearinghouse, and the Federal Reserve Bank could issue its own currency. So it was a way of democratizing the way in which monetary crises were managed or handled, banking crises were managed or handled, and taking it away from J.P. Morgan and the New York
Yeah.
Clearinghouse and putting it in more democratic hands. That's why it
Right.
came about. Then in the 1930s, there was a shift. There was a change in which the legislation elevated the control and influence of the Board of Governors and sort of demoted the reserve banks. But the reserve banks are still a prominent part of the system. So, famously, the Federal Open Market Committee includes five voting members, five of the Reserve Bank presidents. Now, all the Reserve Bank presidents participate in the Federal Open Market Committee. I used to say that, if you were a fly on the wall or watching a video of the meeting, you wouldn't know until the very end when the roll was called who were the voting members and who were not the voting members. So everyone
Right.
gets the same amount of time to speak, to say their piece about policy.
Mm.
It's a system. I'll just point out that a big advantage of which is each of the reserve banks has its own research department. At
Right.
the Board of Governors, you've got a big research department that reports to the chair of the Board of Governors. And as a result, the other governors don't have quite the firepower to bring. They can't go to the staff and get them to do their own studies, or they don't interact independently with the staff to a large degree on policy matters. That's
Right.
all sort of managed and controlled centrally by the chair. But the reserve banks have their own independent research departments, and that means that the Reserve Bank presidents can bring a very independent point of view to the discussion. And there's some interesting work being done by Michael Bordo and Ned Prescott that talks about the role of the reserve banks. There's a NBR paper they just published last month that highlights the extent to which reserve banks have brought really important innovations and insights in monetary policy
Mm.
to the FOMC and to the Fed's deliberations. And I think that's a very important part of the whole structure.
Given this background, Jeff, what changes have been proposed? And importantly, how likely are they? If you see it through a
Mhm.
crystal ball,
Yeah.
what effects would they have, in your opinion?
So I think that the reform proposals I'm familiar with involve collapsing down the number of banks to four or five. So people make that the argument for that sort of reform on the basis of what they think of as economies of scale in operations. So it used to be each reserve bank had its own central computer system, ran its own check clearing, ran its own automated clearinghouse system, its electronic payments processing. Now all of that is centralized. So there's an office that does check clearing. There's an office that does, the direct deposit of payrolls, and there's another office that does the wire transfers, another office in charge of IT infrastructure. So yeah, there has been a lot of centralization, and all those are things that nowadays can be done in a single organization if you want. Now, the Fed's actually taken advantage of all those economies of scale over time by centralizing things by having one reserve bank do checks and one reserve bank do that, Fedwire, for example. So I think that the technological economies of scale to be realized are really they're just not there. I mean, the Fed has done a good job of taking advantage of those opportunities and minimizing its cost. On the other hand, there's sort of an overhead of administrative, leadership. But at the 12 level of the 12 reserve banks, what they're focused on at the leadership level is reaching out to constituents, to businesses, households, nonprofits, labor unions, manufacturers, business people, local elected officials around their district and understanding what's going on in the district. And I think that's exceptionally valuable for a central bank. Every central bank does some of that somehow or another. And I think that the structure of having 12 people around the country, all of whom serve on the FOMC, go to the FOMC meetings, interact with senior leadership. They're not deputies or regional presidents or whatever. I think that's a very valuable entree they get into local communities, and I think it strengthens that local outreach function very much. So I think there would be a loss to that. My prediction, though, given the structure of our legislative system here, is that that's not going to happen. Any reserve bank, has some local politicians. It's got senators and congressmen, and they would fight tooth and nail to preserve a reserve bank in their district. So I think that dynamic makes it unlikely that we're going to close any Federal Reserve offices anytime soon.
And also, Jeff, I was wondering, I mean, wouldn't that defeat the whole purpose of decentralization, of having 12 banks in the first place? If
It
you get rid
would.
of some of the
Mhm.
banks, then that would
Yes.
basically mean concentration of power into the big Feds like the New York Fed, etc.
It would. And that's another reason. So
Mm.
the rationale and the value of the federated system has evolved over the years. At the beginning, it was the idea that Richmond would know best what interest rates are appropriate for our district, and that's gone by the wayside with the unification of capital markets across the country. But this idea that the structure enhances the diversity of views brought to the table and enhances the richness of the local anecdotal information that's brought to the table, I think that's very important.
Right.
So yeah, I think I think it would I think those consolidation proposals are going nowhere. In fact, a few years ago there was a proposal to expand. There's this one district in San Francisco
Right.
that has like 30% of the U.S. economy,
Yes.
and there's a proposal to put a district in Arizona and another one in Seattle, and
Okay.
naturally it was promoted by legislators from those areas.
Yeah. The wealthy neighborhoods.
That's right.
Kevin Warsh, the new Fed board governor designate, Jeff, has spoken of the need of a new Treasury Fed accord. What might that mean, in your opinion?
That's an interesting idea. The word accord harkens back to what's called the Treasury Fed Accord of 1951, the original accord. And that was the agreement between the Treasury and the Fed after a dust up, a fairly significant squabble, to let the Fed control its balance sheet itself and let Treasury security prices go. Before that, the Fed during World War II had been operating under a pledge they made to the Treasury Department to peg, to cap the yield on government bonds. So it essentially gave the Fed its independence to let interest rates do what the Fed thinks they ought to do. So it gave it the independent control of its balance sheet so it could independently set interest rates. And that served the world well for a long time. A new accord, I think, the idea of a new accord is a response to actions the Fed has taken since the great financial crisis on two fronts. On one front, the successive asset purchase programs in which it bought very large quantities of Treasury securities in the 2010s and did that by adding to the base of reserve account balances in the banking
Right.
system, has expanded its balance sheet greatly. And I think what that has raised questions about is who is in charge of debt management, meaning who's in charge of the maturity spectrum distribution of Treasury securities in the hands of the public.
Right.
Traditionally, and as a formal matter, the Treasury, U.S. Treasury decides whether to issue long-term securities, short-term securities, how much of each, and all. But the Fed can go into the market, and in the 2010s, it did this and buy longer-term securities and influence that distribution. And it raised questions about who was in charge, who was deciding on what those magnitudes was. The Treasury could undo what the Fed was doing by issuing more long-term securities, and the Fed could undo what the Treasury was doing by buying more long-term securities. And I think that's very apt. I think that's a very relevant critique. And I think that what's being proposed, and I think what uh, Kevin Warsh would have in mind is some clarity around that, that the Fed sticks to a more neutral stance with regard to the maturity distribution of securities in the hands of the public and lets the Treasury decide on that distribution. So there's a couple of ways to do this. One is to revert back to the Fed's policy from before the great financial crisis and having just a fixed percentage of what's outstanding. So it just mirrors the Treasury's issuance and it does not itself have any effect on the distribution that's in the hands of the public. Another approach that's been talked about is called bills only. This is to revert to what the Fed did in the 1950s, which was to only buy short-term securities, stay out of the longer-term market. The advantage that would have is that it would insulate the Fed from the problem it's gotten into with in the last several years. It had a lot of long-term securities on its books. Interest rates rose, and the earnings on its long-term portfolio didn't rise, but it
Right.
had to pay a lot of interest on reserves, and
Yeah.
so its net income went negative and remittances went to zero. What's more, it has a huge unrealized capital loss on its books. So it's it's bankrupt in a sense, that it says negative net worth. Now that's not likely to have a material effect on its ability to conduct monetary policy, but it could conceivably, and it's a political problem and an accountability issue for the Fed. And I think staying out of that, I mean, for the Fed to essentially do fiscal policy by generating losses like this is kind of a problem. So going to bills only would be consistent with keeping the Fed out of fiscal policy matters, including debt management. And so I think that's a version of this that would be, I think, a plausible candidate for consideration.
So that would mean that the Fed would play a lesser role in deficit financing going forward.
It right, it would stay out of the long-term treasury market. It would just hold bills.
Right.
And that would make it clear that the Fed isn't in the business of monetizing debts. It isn't in the business of inflating away the value of government debt. And I think with the fiscal outlook that the US is facing, I think how the Fed is, how the country is going to finance these large deficits is going to be a looming problem. They're unprecedented in scale for peacetime. And in wartime, you always have this question, how much is going to be tax financed? How much is going to be financed with capital losses on bonds? How much is
Right.
going to be financed via inflation? But to have that question arise in peacetime is a novel situation for, at least for the US. And I think the more clarity the Fed and the Treasury can provide around what their intentions are going forward, the better, the easier it'll be to manage the possibility of expectations being upset on those dimensions.
Hmm. Walsh has also talked about mission creep, Jeff, as a Fed at the Fed and scaling that back. What would that look like ahead, going ahead?
Yeah, that's a good question. So a lot was made of this in the late 2010s. The Fed altered the way it described the maximum employment mandate using words like inclusion and broad-based. And the Fed has added explicit language about climate change to its supervisory practices in bank keep safety and soundness of banking system. I don't think it went too far. I don't think it was putting its thumb on the scale for the purpose of climate policy, but I think it was just trying to signal that it was attentive to financial sector risks that might arise from climate change. I think those were sort of overblown. I think that there's a consensus on that if they emerge and data shows, it would be a longer run thing and something banks could manage over time. Um, the political winds have turned. I think the Fed feels a little bit burned by subjecting itself to criticism for taking somewhat partisan looking political stances on things like inclusiveness and on climate change. So I think a Warsh Fed is going to stick to a more strictly nonpartisan stance and set of communications on issues like that. More broadly, I think that mission creep is a phrase that could also apply to the Federal Reserve's involvement in credit markets. And
Right.
here, what's apparent is that they intervened in the great financial crisis and then in 2020 in markets that they never intervened before in, and at scales they never intervened before, and in ways they never intervened before. Commercial paper market, corporate bond market, and the like. And I think that those interventions, I think, were wrongheaded. I think they were fiscal policy. They were not at all connected to monetary policy in the sense that they weren't necessary at all for monetary policy. Monetary policy is about keeping interest rates, at the rate the Fed wants, and that can be accomplished with by their setting of the interest rate on reserve balances. After they've set the interest rate on reserve balances, there really isn't much else they need to do on monetary policy. Now that's, a big kettle of fish of getting the right number, setting the interest rate appropriately and guiding that over time and guiding expectations about that. But they don't need to venture any further. So, for example, they have an overnight reverse repurchase facility in which they operate in the RP market to take in funds from money markets funds, essentially. That's superfluous. They don't need to do that for monetary policy. That's an example of
Right.
mission creep. And the same thing with the standing repo facility. There really isn't any need for that. And more broadly, they target the federal funds rate, but the federal funds market is like a pale imitation of what it used to be. It's this tiny little thing. It's not even most banks participating. It's just a small, small market. Its importance is just symbolic, and they could do fine with just the interest rate on reserves. So I'd like to see the Fed go back to targeting one rate and doing it with the interest rate on reserves. And everything else looks to me like mission creep.
Yeah, I mean, they do talk about rejigging the Fed fund rate, for example.
Yeah, right. So Lori Logan, for example, the president of the Dallas Fed, has proposed shifting away from the federal funds rate as a
Mm,
target and targeting
yeah.
instead the RP rate. And that's attractive in some ways, but it's simpler.
Mhm.
Once you've set the interest rate on reserves, it's simpler just to say we'll let the RP rate, the repo rate, be determined by market forces. That's what we
Right,
used to do when we targeted the funds rate back before the crisis,
right,
as you know. And there, the only reason for not doing that is this quirk in the law. The law says that the Board of Governors sets the interest rate on reserves, not the Federal Open Market Committee. And the reason that we retained federal funds rate targeting after we started paying interest on reserves in 2008 is that the presidents on the Federal Open Market Committee were unwilling to trust the Board of Governors
right.
to have the Federal Open Market Committee decide on monetary policy, but then the Board of Governors is the one that sets the interest rate on reserves. A simple one-line change in the law would fix that. And that could be
Right.
appended to some other legislation
Yeah.
and make that an FOMC responsibility instead of a Board of Governors responsibility. And I've advocated that for a long time.
The idea of an independent Fed, which seems to be a top priority for Kevin Walsh, it seems to be a bit counterintuitive, Jeff, given the fact that the government wants to interfere in monetary policy. An independent central bank uh, is not equal to interference in monetary policy. So it's a bit of a
Right. So,
confusing. Yeah.
yeah, so this is an interesting thing. I mean, a naive observer of the media coverage about the independence of the Fed might think that the Federal Reserve is a fourth branch of government,
Yeah.
all on its own, able to do whatever it wants. And that's
Mm,
not the structure that is on paper legally. But you might wonder, well, who are these independent, technocrats setting monetary policy for the country? It's so important for the country. Aren't they accountable? And the answer is they are accountable. They're accountable to Congress. And so we have this structure where Congress, under the Constitution, Congress is responsible, is given the authority over money, coinage, monetary standards. That's all Congress's responsibility. The
right.
administration doesn't have any legal role in that. What the Congress did was set up an independent agency and give it responsibility for these things. And so the principle of insulating those monetary decisions from direct pressure from elected officials being able to intervene and set interest rates on a quarter by quarter basis is very important. And the reason goes back to, of course, the incentives that elected officials have to try and stimulate the economy, like the Fed did in 72 in order to hasten, increase chances of their reelection at the cost of longer term damage to monetary stability. So that's an important principle. It goes back to the Bank of England in 1694. It was established by Parliament and insulated from the Crown in order to preserve the credibility of the commitment of the British ruling class to not resort to inflationary finance. And that was important to their ability to issue bonds on markets that, international investors found attractive. And that was crucial to their ability to finance the Napoleonic Wars and beat Napoleon in the
Right.
early 1800s. So it was just crucial to the country, and it's been crucial to our country to maintain that independence. But it's important to recognize that that independence is within a framework of accountability, and that Congress has the responsibility for overseeing the Fed and holding the Fed accountable for bad performance, not for what interest rate they set at one meeting or another, but holding the Fed responsible for the performance on macroeconomic goals. Have they maintained price stability? Are we at maximum employment? Are they doing as well as we can on the labor market side?
Right, right. Very interesting, Jeff. So, do you see any changes happening in the structure of the FOMC in the near term, Jeff?
I don't think so. It would require legislation. I think
Mm.
the key thing is the practice of the chair. I think that I think Chair Powell played a very active role in consulting with members of the FOMC prior to, in the lead up to meetings. I think that every chair has an incentive to know where the votes are and know what they can get approval for going in. The chair sets the agenda, proposes what their action is going to be, but I think they have to know what the votes are going to be and know, how many dissents they're going to get on either side. And I think every chair has an incentive to scope that out to know what's going to happen. But I think that the Chair Powell played a more active role than his predecessors in lining up votes and persuading people to go along with his point of view. And I think that he also seems to have played an active role in encouraging them to uh, communicate in a way that was consistent with the way he was messaging
Right.
monetary policy. So discouraging the external expression of dissenting views. I think
Mm.
that I think that the attitude of the new chair towards those issues, how they handle that, is going to be important. I think that the Fed has been weakened in recent years by a decline in the diversity of views, and I think that um, an interesting question is going to be whether the new chair welcomes the diversity of views, understands the extent to which differing perspectives around the table, brought by people with serious expertise and deep learning in monetary economics, can aid the conduct of policy.
Can you talk about the relationship of the 12 Feds among themselves and with the Fed board? You did touch upon this previously, but maybe you can talk a bit on this in detail. So
Sure.
apart from the FOMC, I believe the Beach Book seems to get all of them on a single platform as far as aligning macro research is concerned at this time. Keen to know your thoughts on this.
Yeah, so the Beige Book is a kind of a small thing in the operations of the Fed. So each bank has a staff of two or three or four people devoted to collecting all this anecdotal information and assembling it in a form. There's one reserve bank. Each meeting is in charge of assembling that Beige Book
Right.
information, but that's just the anecdotal reports. There's
Mm.
a broader research function that's relevant to monetary policy, which is following all the economic data and interpreting that data and interpreting what it means for how policy should be conducted on an ongoing basis. And to interpret data, you need a model, you need some framework for
Right.
understanding how the variables all fit together because by themselves the data don't tell you anything at all.
Mm.
And so that's the real value of your reserve bank research department is you've got people that understand the very frontiers of monetary economics and models, and they're able to distill the data. You've also got economists there that are poring over all the minutia of the data, understanding little
Right.
wrinkles that influence the month-to-month wiggles, little technical factors that affect how you interpret the data, and bringing those two together and hashing out how to understand, how to interpret developments you're seeing in real time and figuring out what they mean for how policy should be set and how it should be done going forward. That's the real rub. And on that, the banks are very independent, and that doesn't really that work takes the beige books as input, but it doesn't influence the beige books at all. The beige books are basically this is what people are saying. This is what businesses are telling us.
Right.
And that independent research function is the nub of this thing. This is what Michael Bordo and Ned Prescott in that paper I was talking about before
Right.
are talking about.
Do you think complexity of the multiple supervisory systems could lead to lack of clarity of roles and consequently lack of
Mm,
accountability? A case
mm,
can be made that regulatory arbitrage can be avoided with a single regulator.
mm.
Therefore, Jeff, do you think that a single regulator among the feds can respond more effectively to market innovation and development as there would be no regulatory gray areas in this case?
Yeah, that's a good question. So the
Mm,
U.S. regulatory system, uh, has a number of federal agencies,
mm,
and I won't get into the details are mind-boggling, but a bank can, by deciding whether to be chartered by the state they're in or the federal government, and if they're chartered by the state, whether to be a member of the Federal Reserve System or not a member of the Federal Reserve System, by those choices, they can choose which of the federal regulators is the one they answer to. But no matter what, if they have a bank holding company and all banks over a certain size kind of find it necessary to do that in order to carry out banking business, you're regulated by the Fed. Now, the diversity of federal regulators means two things. First, yes, you're right. There's the possibility for go shopping around and finding a regulator that's
mm,
a little more lax than the other ones. And at
mm,
times in US history, in the history of banking regulation and supervision, you can find instances in which one agency tries to expand its scope in the banking system by being more lenient, shall we
right,
say.
right,
Um, but so there is that. But on the other hand, it's a certain sort of competitive pressure on the banking regulators to be, it kind of disciplines their ability to uh, kind of be too draconian in regulation. So there's a kind of a balancing act, a balance of forces there. In terms of the division of labor, the division of responsibilities and accountability, I think that's a serious question. I think that Congress is usually able to figure out who was on point. So it's either the FDIC, the Office of the Comptroller of the Currency for national banks, or the Fed, and the regulators will go in and the supervisors will go in to a hearing, and when a bank has failed, there'll be a post-mortem on who was responsible, and I think that Congress is able to sort that out pretty well. There's some finger pointing. The On the ground, there's a feature that there's a sort of a balkanization of information. Sometimes one regulator has trouble getting information out of another regulator that's relevant. Where the rubber hits the road, however, is at the discount window. So the
right,
Federal Reserve has the option of delaying the closure of a failing institution. And its traditional practice has been to do that when it has assurances from the if it's a if it's a bank the FDIC is supervising, or the OCC, of deferring to that agency. If they want to keep it open because they're trying to find a merger partner, the Fed will lend to preserve to keep the bank going. And that decision is kind of a critical one, because if the Fed doesn't lend at the discount window, the bank is forced to close and the other
right,
agency is forced to close it. That dynamic has gotten less attention, I think, than it deserves. And that's where, you want the discount window, at the Fed, you want those personnel to have access to a rich set of information from the other regulator. And you want those decisions to be well aligned. So The FDIC sometimes wants to delay closure in order to minimize the hit to the deposit insurance fund, but sometimes that can skew their incentives, and sometimes that can lead to excessive delays in closing institutions. And this is exactly where too big to fail has come from.
Right,
It's
right.
exactly where the practice of letting uninsured creditors get their money out while the Fed lends through the discount window to facilitate that, and the agency in charge delays closure. It's exactly where that comes from. And the incentives begin, this began in the 60s, and it just grew and grew and grew to bigger and bigger institutions. And now
Right.
it's widely viewed as likely the Fed's going to rescue almost everyone.
Mm. In a recent speech, Jeff, Michelle Bowman talked about the perils of the mortgage business going to non-bank entities as compared to commercial banks, which now interestingly originate just 35% of mortgages compared to around 60% back in 2008. This is a risky development that has been also pointed out by the FSOC. This she attributes to the tweaking of the capital treatment of the MSRs or mortgage servicing rights, which made it expensive for commercial banks by way of higher risk weights on capital for such exposures. In my opinion, Jeff, in a way, this can be termed as an unwanted penalty for banks taking the securitization route. And in line with the current narrative that the system is becoming probably too risk obsessed and needs a cooler approach. What's your take on this?
So we were just talking a minute ago about the too big to fail problem, and
Right.
that's essentially um, uh, a lot of insurance provided by the Federal Reserve and other bank supervisors to a lot of bank institutions.
Right.
So by itself, the shift of mortgages from the banking system's portfolio to private portfolios, it doesn't change the underlying risk. It just moves it somewhere.
Mm.
And if your point of view is that too big to fail is a problem, then you'd want to take measures to counteract it, and you'd want to, you'd want to impose costs on banks commensurate with the risks that they run that they would impose on the Federal Reserve System just because of too big to fail. So you'd want to clamp down on mortgage servicing rights if they're too risky. Now, whether the Fed has gotten that price right or not, whether that charge is correct or not, is a an interesting question. But you might take the point of view that th there's no intrinsic reason why banks should fund mortgages. They have in the past, but the securitization market in the United States is the best developed in the entire
Right.
universe. And so you might argue that, yeah, that risk should be distributed widely, borne by a range of investors, pooled together with a lot of other risks. You might argue that that's the best way to manage that risk. Um,
Right.
this this is an instance of a pattern that's uh, been displayed like for decades, having to do with too big to fail. So there's people view the Fed as likely to intervene, as regulators as likely to intervene to protect creditors of a big institution. The institution fails. There was some risk that gave rise to that failure and that loss. Regulators respond, legislators too, and supervisors respond by clamping down on that risk. And the response of the financial system is that tilts incentives to putting the risk outside the banking system. So there's this incentive to bypass the regulatory constraints, the new regulatory constraints that have been imposed. But that risk is out there. And so the question is, are regulators going to indemnify that risk out there? Are they going to expand the safety net? So, for example, going into the great financial crisis, too big to fail was thought to be something about the top 12 banks. But then
Right.
in 2009, the Capital Access Program, the SCAP, the stress
Mm.
tests, that mechanism essentially expanded it to the top regional banks, the top, I think, 18 or 19 banks in the country. And
Yeah.
so they were sort of declared too big to fail, but that left an open question about the ones outside that set. Well, if you look at the smallest of those 19 and where it was in 2023, it was it was like just bigger than Silicon Valley Bank. So sure enough, Silicon
Yeah.
Valley Bank, these risks arise. It's not clear if they're in the safety net or out. It forces the hands of regulators. They could have
Mm.
let it go. I mean, they could have let it go into bankruptcy. They could have
Right.
let uninsured depositors take a hit, but they didn't. Sure enough, they extended the safety net to those
Mm.
creditors. And so now we have a safety net that, according to the precedents that have been set, go far deeper. So you have this problem of bypass all the time. It was the Silicon Valley Bank was doing things that the top banks wouldn't have been allowed to do in terms of interest rate management. And
Yeah.
so, yeah, this is sort of an instance of that bypass, worries about the risk. So we'll see whether regulators let the mortgage market deal with these risks the way it wants to.
Since we did talk about the SPB, Jeff, just a bit out of context here. Uh, do you think the SPB crisis was a solvency problem or a liquidity problem? And I think that's a big question that a lot of people ask.
Yeah, yeah, no,
Yeah.
and the data I've seen suggests it was a solvency problem. And
Okay.
Amit Saru and his colleagues at Stanford have sort of documented that,
Mm.
after the rise in longer term rates, there was
Exactly.
this large tail of banks that,
Yeah.
but it was also a regulatory problem in that the structure of accounting rules um, just held a gun to their head.
Mm.
They had these unrealized losses in their held to maturity book that they were allowed to ignore. They were allowed to not bring them on the balance sheet.
Right.
And if they took any money, but that was where all the reserves were. They had a bunch of securities out of held to maturity, but a
Mm.
bunch in held to maturity. If they took any out, they'd have to revalue all of them.
Yeah.
So it was a huge
Exactly.
cliff. Yeah.
Yeah.
So it was a badly structured regulation from the beginning, I think, and that's what kind of forced their hand. I think they made some managerial mistakes. I think that
Yeah.
if you're going to issue new capital, you kind of do it first and then announce it, rather
Yeah.
than announce you need more capital and hope you get through, the resulting
Yeah.
market reaction. So
Yeah. But
yeah,
I
that was.
was I always argue in favor of it being a liquidity problem and not a solvency problem because I believe the same story that interest rates increased and that sort of destroyed a lot of banks and generally crises do follow when interest rates rise and I think we have several examples over the last 30 years when we've seen a situation like that.
Yeah. So, I mean, they were borrowing short and holding long-term securities.
Yeah.
My understanding of the numbers is that they were in this tail of,
Mm.
banks that had enough losses relative to their capital to put them underwater. So,
Right.
that's my understanding of their situation. Now, in a situation where solvency is an issue or suspected to be an issue, liquidity becomes the problem, right? So,
Yeah.
um, if you have a liquidity problem, it's because you have some securities that you can't sell. You
Mm.
have some assets
Exactly.
that you can't realize value for.
Exactly.
Well,
Yeah.
uh, in today's markets, you could sell just about anything,
Mm,
given enough time. So, um, yeah, they become delicate, interrelated problems at the end of the
right, right.
day.
Totally agree. In your opinion, Jeff, would the tempering of risk weights on mortgage assets based on the level of prevailing LTVs change the fundamentals of the US housing market and regulatory framework as we know it?
Yeah, I don't have a view on that question. I'm not close
Right,
enough to the numbers and haven't seen the
right,
calculations on that. So, yeah, and it would depend, of course, on the magnitude of the change in the charge. I mean, we have seen historically cases in which changes in regulatory treatment of particular asset classes in the capital rules have seemed to have driven significant portfolio decisions and
right.
movements. So yeah, I wouldn't want to venture an opinion off that off the top of my head.
Sure, sure. Christopher Waller talks about the neutral rate being about 75 bips over the FOMC estimate of 3%, Jeff. And I reckon that to be pretty high. He
Well,
considers this,
so I'm
and he
not
considers,
quite.
yeah,
Yeah. So my sense is that he's thinking of the neutral rate as the interest rate corresponding to the federal funds rate, the long run federal funds rate projections in the summary of economic projections. So the
right,
committee polls its members at four meetings a year, four times a year, and they write down their projections for the federal funds rate, including in the longer run, which is meant to be, a situation in which the shocks have died out, no new shocks have arisen, sort of the longer run steady state forecast for the economy.
right,
And the median for that in the last release in December was 3%. That's been edging up. It used to be
right,
around 2%. But
right,
that's a nominal rate, and it's important to realize what's going on here. So that's for the nominal federal funds rate.
mm,
When people talk about the real rate, the real neutral rate, the neutral rate is a real rate. It's so the 3% nominal federal funds rate in the long run, if you take that as an indicator of the neutral rate, that's a neutral nominal rate. The longer run forecast for inflation is, of course, 2%, their target. So
right,
what the FOMC is saying there is that they believe that the real neutral rate is 1%. And their forecasts range from zero point 0.6 up to 1.9%. So there's a range of forecasts there. There's econometric models that tell you what the neutral real rate is. And those forecasts range from about zero point 0.5 or somewhere below 1 to over 2. There's
right,
the Richmond Fed,
mm,
so-called Lubick Mathis model,
right,
um, has a forecast over 2. So you're talking about 1% to 2% for a real funds rate. Well, you have
mm,
to add the current inflation rate
mm,
to determine what the neutral rate is now in terms of the nominal funds rate. So um, you don't just add two, you get three. If you think
yeah,
the real neutral rate is one. If you think the real neutral rate is one, you add three because that's the current inflation rate. And it's the
right,
expected inflation rate over the next year or so. So
right,
by that measure, if the neutral real funds rate is 1 to 2,
yeah,
then the neutral nominal funds rate is 4 to 5. And on that
right,
score, the current policy stance is pretty accommodative. It's 3.6%, I think, for the funds
yeah,
rate. And on that basis, we're sort of on the very low end of estimates of, whether we're at neutral or not. So I
yeah,
think that's consistent with what you see in the macro data, that the labor market is in balance.
mm,
Um, Labor demand is growing in line with labor supply.
mm,
So you're not seeing layoffs or, overheating there. Nominal wages seem pretty steady. and you've got inflation running at 3% above the target. So you've got inflation too high, labor market imbalance. That tells you that monetary policy is accommodative also. So I think
Right.
policy's on the accommodative side. I think that's pretty clear. So I think there's a sloppiness on the FOMC. I think some FOMC participants are careful about this and noting that it's a real federal funds rate that determines what's neutral or not, and others aren't. I mean, I think that the Chair Powell is routinely makes this mistake of equating a 3% nominal longer run rate with a 3% being neutral now, even if inflation is well above what the 2%
2%, yeah.
longer run projection.
But on the contrary, Jeff, Waller suggests that there's significant pressure on the job market, given that the 2025 job creation number was just one third of the 10-year average of 1.9 million, which he reckons is a risky bet for the economy. While inflation remains elevated, the argument made suggests that tariff induced inflation is not systemic in nature, and inflation excluding tariff is near the 2% target range, as you just mentioned. Now, the problem with this argument, Jeff, is that corporations would either have to absorb or pass on the elevated costs, irrespective of the tariff burden, on to the consumers. And this will, in turn, either unanchor inflation expectations or force drastic policy actions to contain fears. So, what are your opinions on this suggestion of the Christopher Waller?
I'd make 3 points. The first is that we have very good reason to believe that the growth in the supply of labor has fallen dramatically because of the huge swing in net migration between, the
Right.
period leading up to
Mm.
24 and from 25 after. I mean, we have just very good reason to believe that the population is growing much more slowly of working
Right.
age people. And
Right.
so the labor supply should be growing
Mm.
slower. It turns out that demand has been growing more slowly, in part because it's accommodating the fact that there isn't the supply there, but also I think because the uncertainty around tariff policy has been relatively high, and a lot of firms are both they're not hiring and they're not firing. They're afraid to lay people off for fear that they might have trouble hiring back the people with the skills they need,
Right.
something they did experience earlier in this decade. And they're afraid of hiring people just because they're not quite sure what the status of tariffs and just the broader configuration of demand for in their sector is going to look like. So that's the first point I make. Second point I make is
Right.
that this exercise of taking a decomposition of inflation and subtracting parts of the inflation that are attributable to tariff increases it is sort of blind to inflation dynamics. Inflation dynamics are a pool of money that's growing, that is coming to goods and services markets and
Right.
being spent. And the counterfactual exercise of saying, well, if it wasn't for tariffs, inflation would be lower. Well, if you took out the tariffs, there'd still be this pool of money coming at markets to be spent on goods and services. So it's not obvious. It just wouldn't The lack of tariffs wouldn't show up in an increase in inflation in some other sectors. So I think this kind of
Mm.
pulling apart, this decomposition, I think is a sort of a poorly constructed counterfactual exercise. And I don't find it that persuasive. And
Right.
besides, we know that, there's uncertainty and we know that the pass through is going to be lengthy. And there's some studies showing that if the pass through is fairly large. The third point I'd make is that it's the responsibility of the Fed to ensure that any effect of tariffs on inflation are transitory. They can't just
Mm.
say, well, it's going to be transitory. They have to take actions to ensure that it's transitory. And to the extent that it's, a transitory influence, they need to adjust policy accordingly to make sure that that spending, doesn't persist, that those expectations of short-term inflation don't persist and lead people to just start routinely behaving as if inflation's 3%. And the last couple of months of inflation have not been kind
Right.
to us. It seems now as if inflation accelerated towards at the end of last year, and I think
Hmm.
that ought to make the Fed cautious
Yeah.
going forward. And I think I was struck by the minutes. I was saying a month ago, the Fed ought to be trying to prepare markets for the possibility of rate increases
Hmm.
in addition to decreases. They should be more even-handed about the outlook for rates. And you could see sentiment for that in the minutes.
Right. I think they burned their fingers with the transitory narrative post-COVID,
Sure did. Yeah, yeah.
and I think now they are pretty careful about what they communicate to the market.
Yeah, rightly so. Yeah.
Yeah. What consequences do you anticipate, Jeff, if the current administration wants to address the budget shortfall through the tweaking of central bank policies? I mean, this is a bit counter-intuitive here, given the fact that Kevin Walsh would probably want a more independent Fed. But there are a number of examples available globally, Jeff, including that of Argentina's big budget deficit of 2001, Turkey's government influencing monetary policy to reduce interest payment burden and forcing deficit financing in today's context, and of course, the experience of the German hyperinflation in 1920. So, based on the experiences, Jeff, can you briefly talk about how better or worse the situation might get from here?
That's a good question. It's
Mm,
it is plausible that it gets worse from here.
mm,
Last year there was this stunning development. So the pressure that a White House, an administration, or members of Congress have put on the Fed by expressing a desire for lower interest rate has almost always been out of a desire to stimulate economic growth, improve labor market conditions, even if it meant a little more inflation. What was stunning last year was the example of legislators and the White House expressing a desire for lower interest rates on the basis of how that would affect fiscal costs, the interest
right.
expense on the U.S. debt. And that, of course, is the most dangerous thing of all. I mean, that's a path towards a spiral of inflationary pressures as Fed keeps, if the Fed's keeping interest rates too low in order to reduce financing costs. This is what the Fed did in World War II, and the
Right.
the, the country implemented price control, wage and price controls to stem the inflationary pressure. You would need other measures to make that sustainable without a takeoff in inflation. So that's very dangerous. I think the thing to keep an eye on is the discipline on the Fed imposed by its requirement to purchase U.S. government securities in the open market at prices determined by market participants.
Right.
And so that's a way of keeping the Treasury from just raiding the Fed's balance sheet. Congress has raided the Fed's balance sheet from time to time, but you want to keep the Treasury from doing it on a discretionary basis, on a month-to-month
Mm,
basis. And I think some arrangement where the Treasury issues some special non-marketable debt that the Fed buys on some weird terms that nobody understands. That's the kind of thing that you want to keep an eye out for. For example, people have talked about an asset swap,
right.
taking back mortgage-backed securities onto the Treasury's books. Well, the Treasury would
Mm,
have to give the Fed something in return to, be on the Fed's books. If it gives it marketable debt at market prices, great.
right.
But the temptation is going to be to take it back at non, market prices and to value, and to, set an artificial value for the mortgage-backed securities it takes back too. So I think we should keep an eye out for that. That would be a danger.
From the financial stability point of view, Jeff, there are a number of studies describing that central bank independence is strongly associated with financial stability.
Hmm.
In the current environment, what impact do you see on the domestic economy as well as the global financial markets due to the monetization of the deficit you just mentioned, given mounting pressures emanating from rising sovereign debt burdens?
I think erosion of confidence globally and domestically in the Federal Reserve's independence would be damaging to the U.S. and the whole world, I think.
Right,
Um, from the U.S. point of view, from like the point of view of an American consumer, a typical American household,
right,
um, you when inflation takes off, gets out of control, you have financial market volatility because pricing nominal assets becomes more difficult. Those prices become more sensitive to incoming news about the
right,
path of inflation. The path of inflation becomes more uncertain. And that those risks get paid by somebody. That's a cost to doing business that nobody needs to bear and or would bear if prices were stable. So that cost just kind of gums up economic activity, and we saw that in the
mm,
1970s in the United States. In addition, the U.S. consumer benefits tremendously by
mm,
the premium um, paid by investors on U.S. government securities, the confidence they have in the rule of law in the United States, in the stability of our financial system, and
right,
undergirding that is the stability of prices in the United States, the stability of the dollar. Those things undergird a willingness to pay more, a willingness to lend to the U.S. government at lower rates of interest. Maybe it's not 2 or 3%, but it's probably a half to a full percentage point, and that passes through to a lower cost of funding for every American and every American
right,
business.
right.
And so that's a really concrete, those are really concrete costs to American consumers. So if you're taking an American first point of view, not that I would recommend that, that would be certainly a reason to avoid imposing inflationary costs on global investors. But I think for the world as a whole, the world's better off with a single country of the stature and preeminence of the United States, with
Right,
financial markets as clearly, more liquid than anything and stronger than anywhere else in the world. I think
right,
it's worthwhile having that instead of having a bunch of Europes or a bunch of Japans or a bunch of other countries where you have to ask this question, and it's just less deep and less liquid in any given case.
right. In the 1970s, Jeff, President Richard Nixon pressured the Fed to ease monetary policy in the run-up to his re-election. This move contributed to a spike in inflation and was a protracted battle for the Fed, including the Volcker years of the 1980s. Do you think a similar situation is likely to emerge if the government interferes again this time?
I think that's an ever-present risk. I think that the country has learned a strong lesson in the 70s, and I think that affected the conduct of monetary policy in the decades after that, not particularly in the 80s and 90s, particularly in the 90s and 2000s. And I
Right,
think that's what led to this wonderful period between, well, this remarkable period between 1995 and 2020, where inflation was relatively stable and confidence in the stability of inflation was remarkably high in the
right,
U.S. Um, and but you always have the possibility that um, that confidence could be lost again, and that we could lose our way as a country. for new and different reasons. So, part of the success of the country in that 95 to 2020 period, that 25-year period, had to do with convincing the American electorate that they didn't want to go back to the 1970s.
Right.
And as the number of people who actually lived through the 1970s, like myself, fade, age out of the electorate, there's a risk that, those lessons are forgot or diminished in prominence for
Right.
the political system. And I think that's the risk that people are willing to risk it and willing to take a chance on a temporary surge in inflation. So we had a temporary surge in 2021, and inflation got we've brought inflation almost back to 2%, not quite,
Right.
more work to do. But people might feel sanguine about that. Like the Fed was like it was there were a lot of predictions of that the Fed would have to induce inflation to get it to do induce a recession in order to get us
Yeah.
back, but instead they didn't have to. So
Mm.
you people might view that as maybe not as bad as some economists predicted. So they might be willing to do it again.
Right.
But if they did it again, it's not clear that they the Fed would have it as easy a time getting back to 2%. Just because, having done it again, our expectations going to remain as anchored as they've remained. That's an open question. So yeah, it's an ever-present danger.
Very interesting, Jeff. The final question, can we expect anything drastic to happen at this time? Seems some market analysts are already pricing in rate cuts for the later part of the year.
I think they've gotten ahead of themselves. I think
Mm.
this hawkish minutes that were released last week, I think are going to
Right.
seep into market pricing.
Mm.
If the data comes in the way a lot of people are forecasting, sort of consistent with market participants' forecasts, you're going to see inflation stay around 2.5 to 3%. And if it's still there in the middle of the year, the Fed's going to be pulling back on rate cut expectations. I think there's sort of a expectation um, that the president of the United States has been promised some rate cuts, and I think I think it just depends on how the data is going to come
Right.
in, and
Mm.
I think that once in office, when the next chair is going to have both maybe the president in mind, but
Mm.
um, also have in mind their legacy and
Right.
performance as Fed chair. And I think the latter is going to loom large. I think that Jay Powell did a great service to the country
Right.
to show how a Fed's official can survive
Mm.
constant tweets
Right.
of anger and hostility. So
Yeah.
I think the next chair will take that on board and realize life will go on no matter what anybody
Mm.
tweets about him.
Right. Well, on that note, Jeff, that's all I have for today. It's always a pleasure speaking with you. Thank you once again for the time.
Thank you very much for having me on. I enjoyed the conversation.
You're very welcome.